Today, thank you for joining Incubate Vegas on your Saturday evening. Truly appreciate your time for showing up. And we have a special speaker today. Our speaker actually is a part of our Startup Vegas team. Ray is very important to our organization. He does a lot from due diligence for companies that we will potentially be funding, to a lot of the operations in the background. He is a part of what makes us successful. And thank you, Ray, for that. And I will pass it off to Ray so he can give you a little bit of his background.
First of all, hi, my name is Ray Hurst. I'll be doing an intro talk on raising capital and also financial projections. So before we get into that, just so you kind of know the trajectory of this talk / the general outline. So first, I'll intro who I am, where I'm most useful to you, because raising capital is a huge topic. After that, we'll go through the venture landscape, sort of what the actual opportunities for capital injections looks like over time, and also the general roadmap to a major liquidity event, which is presumably what most founders are looking for, and definitely what investors would be looking for. So once we do that, we'll go through how to make your best case, sort of knowing what that landscape looks like, right? And also, frankly, some of the statistics that landscape conveys are important to be aware of. Then we'll go through an example, just a really basic example of how I would go about incorporating my next 12 to 18 months of deliverables and information into projections for a pre-seed raise, okay? The reason that we're gonna focus on pre-seed is I'm assuming that a lot of you guys probably haven't raised capital before. It's not a bad thing. Frankly, that means you're still very adaptable. It's actually quite positive. And you may be able to take some tidbits from this talk and others and maybe augment or increase the likelihood of success in your future venture. Then we'll go through conclusion and then move on to questions. So a little bit about me. I'm a 25-year-old fund analyst with StartUpNV. I got my Bachelor of Science from UC Berkeley. I graduated in the class of 2020, so right into COVID. It was actually kind of a mixed blessing for me. It allowed me some time to pivot away from more policy-focused work and actually get more into finance. And I grew up around startups. I spent some time as an early stage operator, but when I had an opportunity to move into venture capital, I took it because frankly, the opportunities are rare and I was really excited. So how can I be of most use to you, right? So I lead due diligence for syndicate deals, part of the due diligence for a conference fund, and for FundNV, which is StartUpNV's associated pre-seed fund and accelerator. So my expertise really lies on the equity side of raising capital, and specifically pre-growth, right? So pre-Series A, that's sort of the mark that I'd say most useful. Before that, moving on, I'd probably point you towards other associates. Yeah. Yeah, so Series A is, well, when we get to that roadmap, I'll break down each run, but for now, think of it as like the point when your company has demonstrated it's a successful startup and it's now actually trying to grow. So a lot of things change in A, like the rigor of the due diligence, the financial reporting requirements, just things of that nature. So moving from come on, computer, work with me. Okay, there we go. So moving on from who I am and how I can be of use, right? Let's talk about some things you should consider before you raise capital, right? There's gonna be 2 slides here. One, your options from a very, very broad viewpoint. And then we're gonna go into suitability questions and generally, is equity, because that is the focus majority of this talk, is equity the correct decision, right? Venture equity. So before we get onto the equity side, I do want to touch on non-dilutive financing because it can be really valuable to early stage companies. So non-dilutive financing, it doesn't require the sale of a stake in the business to receive capital, right? So this can be a huge benefit to early companies because it eliminates the risk of over diluting, of basically selling too much of a stake in your company before you're mature enough to actually start to justify higher valuations and hence require selling less of a stake for the same amount of money. Some examples of what non-dilutive financing would look like. The gold standard is grants, right? Grants are like, if you can get a grant, it's amazing for you because it's money that you do not have to pay back and it's non-dilutive. If you can get that, please do. Additionally, revenue-based financing is another option. It's really compatible, especially if you're in an industry where POs are very common. And then venture debt is another really useful vehicle. That's the other side of venture capital. It's probably not what you think of as sort of like your run-of-the-mill fund, but it's absolutely still a major player in the space. And then you have small business loans, right? SBA loans, things of that nature that can be a really phenomenal first step. Now, pivoting to venture equity, right, which is the focus, as I've said, it is dilutive, right? So that means that your ownership percentage for existing shareholders, it decreases as new owners come in, right? There's only one pie, and you're just consistently splitting shares out of that. It's more useful to think of it as percentages, but conceptually, you can think of it as the classic pie analogy, right? So although this is a dilutive form of funding, and we won't get too much into the difference between a priced round and a non-priced round, but know that when you're doing a pre-seed or seed stage round, there's a pretty high chance that you're not doing a priced round, right? You don't want to stick a valuation on your company just yet because you're really young. So what that would typically entail is you're using a convertible security. Two of the most common would be convertible notes and then also safes. Safes are a little bit more nuanced, and you could make a case for them. For all intents and purposes, they're both convertible securities, and although they will not represent dilution immediately, they will dilute once everything converts, and those items convert when you have a priced round, right? So that's probably about the gist of the discussion we'll have on pricing / price versus non-price for now. But basically what you're looking at is a dilutive situation regardless, even if you do non-priced. Now, the benefits are huge though, and they are really important to keep in mind. So when you get a VC fund or an angel investor to invest in your company for a stake, right? Typically you get access to their network, and this can come in a variety of degrees of formality. So some funds actually have like a full platform for their founders to basically be exposed to new content, and they really push that initiative forward. Others, it's a little bit less formalized, especially on the angel side, right? If you get a really solid angel investor and you know he's really well connected in your industry, quite a good networking lead there, right? And he's now also, his interests are co-aligned with yours if he's invested. Your success is his success, right? So other benefits include generally just value add VCs, right? Most accelerators are going to give you capital in exchange for stake, but they'll also provide quite a bit of information, expertise, guidance. FundNV absolutely falls into that category, where what we try to do is maximize your chances of success with the money we've provided, right? So it's a non-monetary benefit, but a significant one. Additionally, when you go the venture capital route, the benefit is if you do well, you have access to future capital pretty quickly because your progress is being seen because you're reporting to the fund that you've already received an investment from. And if you're doing well, you can bet that they're going to try to champion your ship for you, right? And really support you when you go to do your next round. The downside, though, is because people are getting a stake in your company, right? You have to be pretty mindful of who you bring on. So if you're dealing with investors where something does not feel right, or if your advisors and your general knowledge are telling you that these are really predatory terms, or this just doesn't feel good, you probably want to listen to that, right? These are people that if they're leading around will ask for a board seat, right? They actually want to contribute to the governance of your company. So you definitely want to evaluate them as they're evaluating you. Moving on from there, in terms of the options that you have, we'll move on to the goals and circumstances that you might be dealing with that would guide your decision, okay? So when you're determining your goals and circumstances, there's a couple questions to keep in mind, right? We're going to circle back to scalability quite a bit, and it's because it is really important to frankly understand and be cognizant of when you're looking at going the venture equity route. So do you want to create a scalable business, right? Or do you just need a small amount of capital, right? Like a translation of this would be, do you actually want to create a company that spans the entire United States, for example? Or do you want to create a company that benefits your local community, is really beneficial to a smaller number of people, but you don't want to scale, right? You're happy with that quality of life. There's nothing wrong with that. But if you know by default that you're not really prepared emotionally or not committed to scaling your business, a non-dilutive track is probably a much better option. So furthermore, are you prepared to give up equity in your business, right? It's not just about intellectually understanding, I have to give up a stake in this business for money. It's, are you emotionally prepared to have other people start to participate in that decision-making process, right? Especially if they take on a significant share of the company. So that's a question that most founders end up being completely fine with. But if you know yourself and you know that you really want to maintain 100% ownership and you don't see really ever getting off this ride, and you're a part of the company, you want to be aware of that, and that's totally fine, but just know that it will probably hinder an equity route, right? Additionally, how long are you in this, right? Do you have a cutoff? Have you given yourself 2 to 3 years to see X amount of traction? And if so, like, one, make sure it's realistic, right? If your cutoff is when I'm dead, that's probably not realistic. Especially if you have like a wife and kids, probably should not be thinking in those terms. Or a husband and kids, of course. So that's something to factor in. Additionally, and the next two are really you can take them as sort of one question, right? So what are your financial needs for the next 2 years? And also, like, what's your financial capacity as a founder to bootstrap this business, right? Do you really need to raise money right now, right? Because especially pre-seed and seed, you're really early, right? You don't have a lot of traction that justifies a good valuation. So you're going to be, even if it hasn't converted yet, giving away a solid chunk of your company for all intents and purposes, right? So the longer you can delay that without going extreme, the better off you'll be, because it gives you time to potentially generate revenue, show other signs of traction, basically sets you up to be a hot commodity, right? So the last consideration that I'll leave you with on this front before we actually talk about the raise and the landscape and everything of that nature is, what do you really want out of this business, right? And this is a positive question. This is like, what is your pie in the sky, absolute peak end goal, everything goes well objective? And then also, like, where's the end of the line, right? That could be an acquisition. It could be a strategic partnership if there was an actual M&A deal involved there. It could be an IPO, right? If you know that you want to be a public CEO, it's more power to you, right? So these are things to factor in, be aware of, and know that they will guide the conversations that you have with VCs and angels. So following on to what it means to be venture scalable, I'll try to move through this quickly, but not only does scaling have to be compatible with your goals, but the team's goals, right? So if you have critical hires, like your CTO is the absolute linchpin employee of your organization, he's got a large share of equity, and he really does not want to scale in the direction that you want to scale, I'd be surprised by that, but it could happen, right? You want to know, because you're probably about to lose a major employee that will also walk away, if vested, with a chunk of your company. So before you go through this journey of trying to go the equity route and going on what is essentially like a hockey stick flight path if you succeed, make sure that your team's aware of what that means. Make sure you're aware of what that means. And also, I'd say make sure that if you have close loved ones and people that you factor into your decision-making process, also make sure they know what that means, right? So furthermore, is the business model itself scalable, right? Like, if you have to go sell every single product, every single time there's a transaction, and it's a physical product, it's going to be kind of hard to scale that compared to selling software packages over a web platform for a monthly rate, right? So it's one of those things where you can maximize your chances of success and minimize the labor you have to put in to generate revenue if you're still at the ideation phase and you consider the scalability of your business model. And also, some business models, frankly, they just can't scale, and I'm not going to say it will preclude you from venture equity, but it would make your chances a lot harder, and it's already harder to get funding, right? So keep it in mind. You can pretty easily find like what business models are typically scalable online. One thing I'm going to try to do in this talk is give you more of the underlying philosophy and thought process from an investment side, so that you can use that to guide your own learning. There's a lot of publicly available information. There's not so much insight into what people would be thinking at a pre-seed stage. So just to sum it up, right? If you can't realistically project significant growth over 5 years, and if you can't also name the limiting factors to that growth when you're pitching, those will be points of concern, honestly. And it's not good or bad, right? But it's just, keep in mind, every single thing that you do in this pitch, the investor is going to be trying to gauge, is there a plausible pathway for you to, one, get to a liquidity event for them that would actually justify their investment, and two, are you doing anything that not only makes it plausible, but maybe de-risks your investment a bit? So moving from there, here's the roadmap. Lots of build up to get to the roadmap, but it's all relevant, so it does have to be factored in. So the first time that you really have an opportunity to put money into the company in exchange for equity would be a friends and family round, to raise capital for the company in exchange for equity, it would be a friends and family round. So this is about as close to raising on a napkin idea as you could probably get. And some people, if they're repeat founders and have insane networks and are just a literal statistical anomaly, can raise on a napkin idea even later. But let's not use anomalies as our benchmarks, right? Let's set you up for a realistic course of action. So the one thing I'll say about friends and family rounds is be really careful with intermingling your relationships, right? So if your aunt is offering to put in 200 grand into your startup that has no revenue and she doesn't really understand investing, you might want to be pretty careful about that, right? Like, I won't go into too much detail here, but there's horror stories aplenty. You will be able to find them. Just act with integrity, be mindful, right? Because the thing is, when things are this early and there's so much variance in what the outcome could be, and you're dealing with family, you don't want to burn any bridges that you don't have to burn. Moving from there, you go to pre-seed, and this is also, the pre-seed round is typically when you'd start to see more angel activity. You might see some of it in the friends and family stage, but let's assume pre-seed is when you really start to interact with angels heavily. How am I doing on time? Okay. Moving to seed and series seed, right? So this is really like your first big round. It's not necessarily a price round. It certainly could be. But this is when you're no longer in the tinkering phase, right? You are a startup. Like, we have 12 to 18 months to demonstrate enough traction to get to an A round and then really start to try to get on a rocket ship growth path, right? So seed, series seed, yeah. And feel free to ask questions as we go, of course. So, and series seed, just to let you guys know what this is, and it paints a slightly less urgent picture, right? Seed conventionally would just be one round if we were going off of precedent from 10 years ago, and then you jump to A. But the thing is, people have needed additional rounds of financing, and it's occurred enough that some of that has become precedent. So you'll frequently see a seed A and a seed B. Those are series seed rounds, right? So you're just splitting up that round. You still have dilution risk there, though, right? It doesn't get rid of the fact you're giving away chunks. So be careful if you go that route. At this point, what you're trying to do is, like I said, demonstrate traction. We'll get to what that actually means in a second, but it's getting you to the point where all of the due diligence is about to kind of go up a notch, right? And also the expectations of your performance as a company are about to go up a notch too. So that's when you hit growth, right? This is where you start to think of your classic venture success stories, where you think of like people or companies in like the pinnacle of their success, right? 85% year-over-year growth type models. So like crazy, seemingly, but the reason that happens, right, is because there has been so much work on the back end, right? So although it's a hockey stick, it's really a deferred returns. Okay, so moving from growth, right? And your first foray into growth would be an A round. Okay. And then you would have your B and your C. So C is, I think we're good here. Thanks. C is sort of an intermediary between growth and late stage. You could classify plenty of C rounds as late stage. When you start to get into growth too, acquisitions start to become a real talking point. When you go from growth, then you go to late stage. This is where you see CD&E rounds and things like mezzanine financing you get right before an IPO, right? And then you get to the holy grail of your targets, at least if you're trying to see a return, which is an exit, an IPO, another major liquidity event. These are the two most common, an exit or an IPO, with an exit being significantly more common. So what's the translation of this roadmap, right? What does this really mean? So this is a translation of the roadmap, and it is absolutely reductionist. This is super simple for how difficult the journey is that I just outlined for you, right? But it's good to keep it in mind in this mindset, at least for the stage you're at, right? Because when investors are looking at a company in pre-seed stage, what they're trying to do is typically figure out, is there any way that this investment could pay off? It's already not likely. Is it even possible? Because if they can cut out the ones that aren't possible, they're probably going to mitigate their chances of total failure quite a bit, right? So I won't go through the take note here because we are actually getting close on time. So, but basically risk reward is at play in a very big way here, right? So the further along this line you go, the less risky your company presumably is. Hence, the reward needs to be less monumental, which also means that the valuation you could ask for in these rounds will be higher. So in summary, the stage that we're operating at, right, is really here. So just to couch the rest of this, the majority of the guidance that will be given is pre-A, right, post friends and family, and focuses primarily on how to address the risk factors and how to basically give an investor some hope that you know what you're doing better than everyone else around you. Yeah. Oh, cool. Okay, perfect. Perfect. All right, so zooming back to this roadmap, right? And now discussing how the investor is going to look at this roadmap and translating it from what you're actually trying to do to how hard it is to do, right? Although this data is slightly out of date, the theme is very much alive and well. This is a demonstration of risk in startups. Before Series A, about 60 to 70% of companies that have received a round of financing never get to another round. They just die. So what this looks like from an investor's end at a pre-seed stage is that your portfolio management has to be pretty specific, right? So an investor is not looking, they are looking at your company individually, of course, but really what they're doing is situating your company within a larger portfolio of startups, right? And all of those startups have to have a chance of succeeding. And if we're working at pre-seed, right, where we know that within 2 rounds, we're going to hit this basically big culling event, right? This big attrition event. We're going to want to see everything we can. One, to make sure that the deals are set up in a way where we can actually make solid returns off of the investments that don't die. And 2, we're going to want to see founders that are aware of this, are doing everything that they can to mitigate this attrition rate, right? And doing everything they can to insulate themselves and figure out how to get through this phase. So although you're going from A to B, right? Although you're on that linear growth path, a big consideration when you're pre-seed is just how to get to seed. And a big consideration from seed is just how to get to A, right? So you have to keep in mind your end goal, and you can't sacrifice, or you don't want to sacrifice your end goal for the sake of just getting to your next round. Like, you don't want to sell 50% of your company just to get to your next round, because then you might not have another round, right? But at the same time, although your end goal is important, you need to be stepping stoning this or doing this in a stepping stone fashion, or you just won't make progress. Now, moving from risk, right? And this is where things get really interesting, because if the risk in startups is really high when you're that early, people probably don't want to buy startups when they're that early, right? Kind of. Acquisitions actually start in pre-series A, and not in an insignificant, and in an insignificant way. I mean, we're looking at roughly 30% of companies in a cumulative fashion getting acquired pre-series A. That's pretty good. But here's the thing. They're getting acquired cheap, right? There's probably not a lot of companies in here that are getting acquired for big home run exits where the founder's really happy and the investors are really pumped up. It can happen. I'm not saying it's impossible, but like, frankly, you have to be truly exceptional, and or your company has to be truly exceptional, right? And when we're looking at how to set you up for success and how to talk to investors, right? It's not about proving that you're the one and only, because they hear that from every founder all the time. What it's about is showing that you have a realistic grasp of what's going on. Yeah. So it's not about proving that your business is fundamentally unique, has not been done before, anything like that. It's about showing that you have a legitimate and realistic path to capture enough market share to justify the deal terms that you're coming in the door with, and to represent your investors with a return potential that is commensurate or in line with their investment criteria. You might not know what those are, but what you can consider is, if at pre-seed, they probably want grand slams when they have successful investments, right? Like grand slams, like big payoffs. And the reason is, frankly, 6 to 7 of the companies for every 10 they invest in, if we go off of macro data, is going to fail. So like, it's just to compete with it, putting your money in the stock market for a fund manager, those returns have to be high, or venture capital as an industry just isn't competitive with putting your money in an index fund. So that's why those returns are so crazy. As crazy as they sound, it's actually quite boring. Like, why the number is that specific. So here, just summarizing, right? Major liquidity event potential rises as you're likely to get acquired, right? So you might get acquired down here, right? But it's probably not going to be a major liquidity event. It's going to be something where, they might pick you up for cheap because you over diluted and you have a really cool product and you would have been a killer business, and they're going to buy you for your IP or for whatever infrastructure you have set up, maybe keep you around, but it's definitely not going to be the outcome that you or your investors are looking for. So realistically, the time where acquisitions start to get really interesting is typically around like B is when that would start, right? So C is another, like for example, right? FundNV, when we're doing our exit modeling, what we do is we gauge, we aim for a 35 to 40x, right? And this factors into our deal terms. And that's because we follow a model where we have to do that, right? Just to be competitive. And to actually offer our investors a suitable return, right? It's part of our fiduciary duty. But for us, what we do is we actually have the acquisition target be at a C round, right? Because the thing that happens for pre-seed funds, and this is as in-depth as I'll go on this. This is probably already a teeny bit more than you need, but past C, if you're raising more and more and your early investors aren't continuing to re-up their percentage ownership in your company, they're eventually going to get diluted out. So C is kind of a sweet spot for a really early fund to see a large return without having to do any sort of re-upping and reinvestment. So that's how our fund works. That's just one example. And you can also ask VCs like what their thesis is, what their payout model is. If I saw that, yeah. The best way to think of dilution is that you have this fixed number of seats on a rocket ship or on a plane or whatever it might be, right? And as people buy in, they have an allocated spot, but the actual size of that seat, right? And like, frankly, their overall experience will shrink as more people come in, right? It's kind of a convoluted example, but basically what it is your percentage ownership decreases as new investors come in, right? So if you were all holding on to a segment of a circle or like an item and enough people came in, eventually you're literally going to get crammed out where you're holding less of that item. Very simple way to think of it, but that's for all intents and purposes what's occurring. And for the person in chat, I hope that was, oh, it was Maggie, cool. I hope that was sufficient.
Okay, so another question. I think these charts in theory make sense if this was 2021. With the market where it is there not a realignment by VC firms to not invest in high risk, even at an early stage?
VC firms only invest in high risk. So let me unpack that a little bit. So in terms of, I'd be happy to discuss individually some of the points in this, but VC firms already assume a really high risk tolerance, and frankly, 2021 was a complete black swan year. This attrition rate is probably more in line with what you'll see outside of 2021 because this data comes from a period of time that went through one of the biggest recessions since the 30s and killed a lot of startup ecosystems. So I'd say that this is probably a decent benchmark as opposed to recent data. I'm really curious where the theory of this being more applicable to 2021 comes in. I'd love to touch base offline on that. There's more free-flowing money at literally than any other point, M2 supply money, right? Free-flowing money in the hands of regular people than at any other point in the United States history, or I think recorded history. So really hot market, right? That means there's a lot of free-flowing capital. That means that VCs also have more free-flowing capital because people have more free-flowing capital. People invest more when they have more money, right? So if you're in a hot economy, right, in an inflationary context, or just before inflation starts to get to the point where the Fed actually wants to tone that down, you're probably going to be in a situation where getting venture funding is easier than normal because there's quite literally a larger supply of funding, right? And it will be interesting to see what happens as we progress through time. My hunch is that probably 2021, I think the attrition rate will probably be as high, if not higher, from let's say 2020 to 2026, pure speculation. But the reason is, frankly, the rigor of due diligence done on deals was way lower than it would be in a time of economic contraction. People have more money to play with, frankly. Not at early stage, but some of the really big venture capital funds were really not actually fulfilling their fiduciary duty in terms of due diligence. So it was like easier to get money as a founder that maybe didn't actually justify it, right? Or maybe should have gotten worse terms.
Right, Ray. So let's just say things will change when the economy turns down as it is doing now.
Yeah.
But they still are going to invest. It's just that they're going to invest with lower valuations. They may take longer to do their due diligence. They may be more thorough in doing that. So
exactly.
They're going to get a little more picky about who they invest in, but it's still risky. Tell them the figures on if you make 20 investments, what's going to happen to them?
Oh, well, yeah. So just as a baseline, right? And this is not just based off of data from 2003 to 2013. Like a lot of funds follow Peter Thiel model of venture payout, right? Which basically is a thesis that the majority of your payoffs or your investments will never pay out to you at all. You'll just lose your investment, especially at pre-seed and seed stage. So about 70% of our portfolio, if in line, or in any other pre-seed fund, seed funds portfolio, if in line with that data, will show a really, really high attrition rate where 3 companies have to absolutely crush it, which also means that every other person in venture capital that's looking at the industry from that model is thinking the same thing, which means that it's harder to get additional funding or financing if you are not set up early to actually follow a decent flight path in terms of valuation steps. Okay.
Sunspots, but let's go back to the 20 companies. So when a fund invests in 20 companies, 14 of them are going to fail outright. Okay,
yes.
No return on investment, zip. Okay,
yeah.
That's why you're just better off thinking that you're burning money when you invested in a startup. It's all high risk.
Yeah, and that's spot on. And it touches really well on the first item here for how to make your best case, which is you need to adopt the investor's mindset. Okay, and that means that if you're at pre-seed, they're assuming that for them to even continue to talk to you, you need to be exceptional. In all honesty, you already need to be anomalously good at what you're doing if the investor is actually doing their job properly, because the chances are you're going to fail. So if you're already exhibiting red flags from day one, you're probably not going to get investment, right? So one of the best ways to not exhibit red flags, right, is to adopt the investor's mindset. Another is to target your rounds properly, know what you're actually able to ask for in your rounds. Size your rounds safely. That doesn't mean go with like what is like the biggest valuation for pre-seed or biggest round size for pre-seed that's ever happened. Like, don't go off of precedent, go off of what's reasonable, right? The thing is, most investors, if you have a company that's demonstrating some promise, will be willing to make a fair deal, right? Some will always want to tilt slightly the other way, but a lot of people are actually willing to make a fair deal. So, and finally, you need to make relevant financial projections. For the stage that I'm assuming most of you guys are at, this is going to be pretty rudimentary. You don't want to go overboard. It's really just making sure that you're thinking of it, making sure that it is present. But most investors will not assume that those projections are accurate. So for adopting the investor's mindset, the big thing that I wanted to touch on was bias. So the different biases that you might run into. So investor bias. So for industry, basically a lot of funds fall into 3 categories. They fall into generalist funds. These are funds that invest in just about anything that strikes their fancy, right? As long as they see real promise or potential. There are sector-specific funds or specialist funds that really only invest in, 1, 2, maybe 3 industries. This is really common with SaaS VCs or software VCs, also with AI VCs, things of that nature. And then also you have thesis-driven funds, which are funds that might not actually preclude an investment in an industry by naming the industry, but they may well preclude it just by what they actually need to see in terms of the dynamics of the business, right? So an example of that would be, I'll use my own experience, right? FundNV really values capital efficiency. So we might assess companies that have some pretty significant capital requirements, but it will be a hard thing for us to get past if it's something like you're trying to build rocket ships, where it's just so much money year over year to get off the ground, right? That's what's meant by capital efficiency. Running or programming a few lines of code, right, obviously takes less capital than building a physical product most of the time. Once again, speaking in generalities, right? Okay, next bias to touch on is your exit strategy. So most investors do prefer an acquisition-based exit strategy as opposed to an IPO. This isn't at all completely 100% ubiquitous, but the reason is the logic makes sense, right? Less than 1% of venture-backed companies actually get to an IPO. That number is a bit of a moving target, but typically you're looking at an extremely small minority of the sample size, right? So a private market exit, since it's more likely and can still yield monumental returns, a lot of investors are going to have no problem seeing that, right? Also, a lot of the time, a private market exit, although far out in the future might be closer than an IPO, right? So one other thing that I'll mention on exit strategy to keep in mind with bias, because some of you guys will probably be approaching angels, right? You need to also keep in mind the actual time horizon of investors. If you're dealing with individual investors, keep in mind how much time they actually have to invest in the market, right? I won't share names, but I thought this was extremely useful to consider, and how you can situate each discussion you have by trying to take this bias list and augment it a little bit with the actual case by case that you're dealing with. An older investor who's still very active, but he was looking at a syndicate deal, and the founder wanted to IPO. Killer founder, killer company. A lot of people are excited about it. And the investor, he's about, I think he was like 80, 85. And he openly said, that's rare. Most of the time you'll run into younger people, but he openly was like, this is great. I love this. But I mean, with the IPO, like there's a real chance that I'm not alive to see a distribution, right? So keep in mind who you're talking to, right? If you're talking to like a 35-year-old VC who just like exited being an operator and has his whole career ahead of him, might be more receptive to an IPO, right? You want to be honest to like what your goals are, but also tailor what you're saying while still being ethical, right? So touching on revenue, there are some biases around revenue, and you know, I'm going to say these aren't generalities, but frankly, they're pretty common, so you should be aware. A lot of people really value SaaS business models, which typically or really only means recurring revenue, and then you can have auxiliary revenue streams, but it means that your bread and butter would really be recurring revenue, monthly recurring revenue, right? So MRR, or monthly recurring revenue, it represents less labor effort on the part of the operators than singular transactions, right? Because every time you have a singular transaction, there's a chance that you actually legitimately don't have that transaction coming back through. If it's a single purchase item, you have to go sell that item every single time that you're getting money in. If it's a subscription to a service or to a virtual product, right? There's a point when you actually have retention that doesn't take any of your effort. And when you're early, that can be really helpful. It's also when you start to scale, massively useful to have recurring revenue. And then finally, on valuation, this is more of sort of a brownie point opportunity, like a moment to set yourself aside positively. A lot of the time, honestly, especially at pre-seed, although you're probably gonna be working with a value cap, you're not gonna be doing a price round. Put some thought into your value cap, right? Don't have your value cap be like wildly large, like 50 million pre-revenue. Don't do that. People do that. That's why I have to say this, right? It's like, so just in case you guys like need some ballparking on what's okay and what's not, just try to be sane, right? Also looking for not only precedent in your industry, right, in terms of your acquisition targets or in terms of early funding, but also looking at like what's relatively appropriate, right? If you're in an industry where like, look, this is something that isn't even in favor of the investor, but could be a legitimate factor, right? If you're in an industry where it might be hard for you to justify raising a certain amount of money on a certain valuation now, but when you actually look at the industry, it's almost like it's a requirement of entry almost. A good example is like motorcycles. It's crazy hard to start a motorcycle startup without like at least 20 million on good terms. That's an example where you can look at that, and if you have a good rationale, that even if it's not market-based, that would be rare, but if you have a good rationale for your valuation, please include it, right? Much more commonly, the best way to do a robust rationale would be one that in terms of your value cap, or if you're doing a price round evaluation, would be compatible with the actual, like the expectations of return that you have and that also your venture investors potentially would have, right? So basically make sure that you're compatible with that scalable model with your valuation. Because if you come in at a huge valuation right off the bat, no one is going to think that you've proved yourself enough to justify even keeping that valuation, right? On a good day, you get a flat round, which means you keep it. On a bad day, they would actually do a down round and everyone's proportional share would go down and the value of their shares would go down, right? So not good, not good at all. Here we go, cool. All right, so next, when you're going about trying to make the best case for yourself, right? You wanna know the expectations for your target round, not only in terms of like where you should be, but also what you can ask for, right? You don't wanna go in and ask, frankly, for way too little or way too much. Because if you ask for way too much, you're just not gonna, unless you're killer, you're probably not gonna get a follow-up meeting and you're gonna be wondering why, waste a lot of time on it. Better to avoid, right? So make sure that you know what you're getting into, right? So at pre-seed, investors typically expect a proof of concept. You rarely can get away with not having one, but assume that you probably need one. And then also a lot of the time at pre-seed, we're looking for signs of life, right? Signs of early traction. So this could be positive customer testing, early revenue. Any revenue is better than no revenue, okay? Because any revenue indicates that it's evidence of at least some demand, right? Because honestly, until you actually get revenue, there's a chance that you build a product and no one ever comes, right? So it's a legitimizing factor. And although a lot of people would say you don't need revenue at pre-seed, you don't, but it's a really good differentiator. And then lastly, very important, your check size is going to be really small, not crazy small. You can do a lot with 50 to 200K, but it's going to be not enough money to like forget about money, right? You're really going to be focused on the next 12 to 18 months and making sure that you can survive that when you get a pre-seed raise, right? Because what you're trying to do from pre-seed is jump to seed. Now we'll talk about the expectations of seed stage, right? So at this stage, investors really do expect to see market traction, right? This translates to, for SaaS business models, about $10,000 to $50,000 monthly recurring revenue. And for non-recurring business models, so transactional models, it'd be closer to like $1 million in annual revenue. When you get to Series A, right, and once again, this is sort of like that big make or break moment where if we went back to that attrition curve, right, it was going out here. It's that point where the percentage drop falls off, and a lot of the people a lot of the companies that are still surviving have a higher likelihood of continuing to survive from that point on, right? So when you get to A, investors want to see some pretty solid traction. We're talking $5 to $10 million annual recurring revenue if it's transaction-based, non-recurring. We're talking $150,000 monthly recurring revenue. Year-over-year growth needs to be really promising, right? 85 is just a classic one to throw around, but what the point here is that you really need to be able to scale in a dramatic way, or what happens is you don't get to your next growth round. It just doesn't pencil out, and then you're stuck. And then you're probably looking at getting acquired potentially for an unattractive deal. So you don't want to get stuck in growth stage. Like it's either you get there, you do just enough to either get to an exit or get to the point where you're self-sustaining, or might be better to go seed stage or a non-dilutive route, right? So another thing to keep in mind here is that your financials just need to be super clean. This is when generally accepted accounting principles and just overall like overhauls to your infrastructure as a company would be required. So super clean data room, right? Like you need to be able to on a dime provide your investors with the information they need. So now that we know the expectations of sort of what you can do in each round, and now that I also provided a quantity for the pre-seed, right? We're going to talk about how to size your round and how to start thinking about avoiding over dilution, right? I want to emphasize that deal terms, term sheets, everything of that nature is a really important topic. It's also complicated. We're barely touching the surface of how to actually do a deal right now. This is all just getting you ready to start thinking about it, right? So things to remember, right? When you're sizing your round, you need to remember that the company needs enough money to get to its next round, but you want to give up as little equity as is reasonable in order to get that money. Right? So as a rule of thumb, you want to keep the maximum percentage of stake given away at each round to the following numbers. And these are actually pretty high. So these really, if I were a founder, I would love to, if I could at pre-seed, go for 10%, right? So obviously as a founder, you're always trying to push it lower, right? Because you're just getting more money for less stake in your company, right? So it's a better deal for you. But at pre-seed, what you should keep in mind is, and it's unfortunate, but a lot of the time you'll see companies that just might need like a lot of capital to get off the ground. They might just be in an industry that's got a bit more of a hurdle. And they're like, oh, okay, like we can raise, but we're going to raise and give away 45% of the company on our first round. Like that's really bad, right? That's painful. So you want to keep these in mind because I'm not going to say it's pointless to do a round if you over dilute, but it's just tragic to see a founder get diluted to the point where their own incentives might not necessarily be compatible with like the long-term health of their own company, right? So avoid over dilution. It causes quite a few problems for you. You can buy back in, you can do all sorts of things to stay involved, but it's better to just never get there, right? So for pre-seed sub 20, I'd say realistically, you're looking at probably 15 to 20, ideally 10 to 20 is the percentage you're looking at giving away. And then knowing that pre-seed rounds usually mean 50 to 200K invested, that means that the value cap, if you're not doing a price round or the valuation, You could reasonably have that fall in the low to high 7-figure range and still be able to avoid over dilution and probably not raise too many eyebrows. Plenty of people go for a $10 million valuation or value cap right off the bat, and that's fine, but justify it. If it's just because that's the average, like most people are not going to find that to be compelling logic, because the average clearly is not good enough if well above the average number, or sorry, the average is not good enough if well over half of the companies at this phase are already failing, right? So you want to be above average, right? In terms of discussing financial projections now, and how you can take that sizing discussion and overall your knowledge of the round you're in and your investors' concerns, I'm going to couch this in what you should do for your first round, right? So I don't want you to think you have to go overboard when you don't have any traction, right? I'm assuming that all of you are probably currently working on market sizing, determining what's a realistic capture of market share, things of that nature. And if not, you will be given support shortly. But what you're trying to do here is really, yes, you can speculate on a flight path over 3 to 5 years, and you should. So pencil that out in whatever way is applicable for your business model. Just make sure that it's annualized, right? And make sure that it doesn't contradict your other claims. It's just, you don't want to shoot yourself in the foot right away, right? If your projections are super optimistic and they mean that you have to capture, say, like 15% of your SOM, like your obtainable market in like the first year, some crazy thing like that, people are not going to see that as a good sign, right? So, and when you do projections, you want to make sure that they're as much as possible rooted in evidence. If you have revenue, great, root it in that. If you have contracts, great, root it in that, or positive and relevant KPIs. All of that will hold more water than just an arbitrary projection. Like every single startup that meets with a VC comes in with a flight path that looks like they're going to kill it and be the next Amazon, right? Clearly that's not enough, because it's not like they're all the next Amazon. So some key guidelines, right? As we talked about, your projections should be compatible, right? Your market penetration and sizing claims should back up your projections, especially for the next 12 to 18 months, right? Because there's a big difference between your projections that, like, when you're at growth stage and your projections when you're still getting off the ground and you might not even have the infrastructure yet to like take on customers, right? So your next 12 to 18 months, this is something that I think that you should really factor in. And it's technically, this is a part of your ask, but really, as you're looking at how to project your future success and as you're looking at how to make your case in a pre-seed round, this period of time is critical, right? Because it's all about achieving the milestones in the next 12 to 18 months that are required to get to a good opportunity for a seed round, right? So basically what that means is you have to not run out of runway, which can actually be a lot harder than it sounds, right? Because business expenses can be variable, right? If you have a finite amount of money, you want to be careful. If you can build in buffers where you actually have some room for error, it's probably really smart to do that, right? If you're going out to raise and you're debating when to start, if you already have like runway issues, you probably jump on it quickly. It'd be better if you can to plan raises when you don't immediately need capital. Like example, for pre-seed guys, before you go and say, expose yourself to like a ton of personal financial risk, like yes, bootstrap to a point, right? But if you're at a level where it's like, I can't take this business further without getting venture equity funding or another significant injection of capital, then that's a reason to go raise without bootstrapping, right? You don't want to let things go too far. But okay, so sorry, just to couch this, bit of a tangent there, let's circle back. So on your projections, what I'm going to do now is, this is what I would add to pre-existing projections, right? So if you have for 3 years, you've mapped out like your potential revenue based on whatever logic you have, this is what I would want to add if I were going in and trying to get money, right? So say that I'm a founder and I'm raising my pre-seed round and I'm approaching an accelerator for investment, right? And we're going to keep this really simple, but this is just a thought exercise, right? So I have no revenue, right? But I want to change that. And I really want to go for a seed round in 18 months. I have a proof of concept and I know that my addressable market, right? My target for really like the near to midterm life of my company is that 200,000 customer number, right? And we're gonna convert that into an actual dollar sum in a second. I just wanted to break this down so that you guys could fully understand what I'm doing. So I know my market size in terms of quantity of customers. I have my proof of concept, and I also know my monthly spend, and I don't think that this number will change, just once again to keep it simple, right? So I also know my monetization strategy. I'm selling to enterprise customers and I'm using a recurring revenue model and I make $500 per month per customer, right? So if I sold my entire SAM in year one, I'd end up with $100 million in monthly recurring revenue. I would not say that is a realistic target for your near-term 3-year projection. I don't think that's realistic at all. So what I'd suggest you do, right, because you have your market sizing and you're trying to figure out how to pair that in with a way to create realistic projections of your near-term success, right? You can have your flight path for when you actually like find product market fit. Don't change that. That's all great. But like, you're not going to hit that like probably for the next 24 months at least of your company's life, right? So knowing that, what I would do in that situation, right, is I would take the info that I had and I would then go figure out what I need to do to set myself up for a really, really good seed round, right? I would craft my projections in a way where, yes, I have the longer term, we're going to crush it. This is when we get to growth stage. This is what this looks like. This is proof this is scalable based on these assumptions. What I would have that I would argue is probably going to positively raise more eyebrows at pre-seed would be a very clear idea of what you need to get to your next round. For this context, it's 100 required customers, right? So I aim for the high end of what would be desired at a seed stage, because I'm setting this up to try to optimize myself for a really good next round here, right? So say that I made it work. I had enough time to get this traction and I didn't run out of runway, right? So basically, to make sure that I can do that, I would need to figure out how much capital I need in order to reach that next round, right? So here, what we're doing is we're taking that spend, right? Here it's a non-variable number. It's just $3,000. Probably gonna be higher than that. Just full disclosure, probably will be higher than that. But I know that my target, my minimum amount, right? If I have nothing change right now in my burn, I have nothing change in terms of my timeline. I am absolutely spot on to my roadmap. I need 18 months worth of funding, which translates to about 54 grand. That's my minimum ask. And our projections should justify this by frankly displaying a reasonable trajectory to the next round, in addition to scalable growth, right? So don't just have a hockey stick from like year 2027 to 2032. It's like, that's great. Like you can make Excel like representations of data. That's lovely. What's additionally useful is situating that a little closer to where you're at and frankly, where you're far more likely to fail in the near future. So if you guys have a realistic idea of like how you're going to get to your next round, you're not going to be ahead of other founders, but a lot of founders come in not actually knowing how to break that down. And if you come in with that, it'll be not a feather in your cap, but a positive mark, most certainly. Yeah, I think we're good. So on this, I'll move on to closing thoughts and then plenty of time for questions. So this talk really is an introduction in the truest sense, right? We're barely scratching the surface of deal details and valuation. So areas for additional learning that I would recommend you look at for kind of because this talk really is sort of trying to guide your mental frameworking as opposed to teach you line by line how to go about creating projections and how to go about raising on X financial instrument, right? That's not what this talk was. This talk is meant to gear your understanding for future learning. So I'd recommend you look at term sheets, safes, and convertible notes in detail. Deal terms in early stage venture capital, specifically pre-priced rounds. And then I'd also recommend that you look into venture capital dilution mechanics. This can be a rabbit hole. I wouldn't say that you need to become an expert, but you want to at least be aware. Looking at things like how a waterfall analysis actually can impact like pre-money safes. They can dilute the founders more than you might anticipate. I think it's like an additional couple of percent. There's all sorts of interesting things that you can learn that can help you in your raise. But the point of today is really to give you a little bit more insight into why early stage funds would ask for what they ask for, and also how you can address some of the concerns that they typically have going into conversations, right? So things that you should remember sort of as closing points, right? The venture equity roadmap really requires scalability. So as much of a case as you can make for that and as much proof as you can get on that front early, the better you will be. Additionally, always back up claims or projections if you can with evidence, right? And if not evidence, with some sort of relevant and important KPI that would indicate a promise or a sign of life, right? And then always prioritize capital efficiency in your ask. This is critical. A lot of people come in and they want to without having any roadmap for how they're going to accomplish this, spend a few $100,000 on technical talent, right? Or like develop machine learning models with a couple $100,000. That's not going to happen, right? So you need to make sure that your asks are actually feasible, right? So if you need $50,000 because you are launching a business that has a pretty reasonable monthly burn and you can really like feasibly run it in-house outside of this pre-seed investment for the next like 6-12 months, maybe hire one person, stay super lean, that's going to be kind of attractive, especially if that business could grow. But if you got to hire 10 people right out of the gate, there's like pre-seed funds can't even help you with that unless you're going to pay them. What would that be? 20 grand a year? There's no way, right? So I hope that this was helpful for you guys, and I'm looking forward to questions. So I'm sure there's probably questions on what we've discussed here, because there's a lot that frankly we could go into much greater detail, but I don't want to throw the whole book at you. You know, let's keep it here, and if you have specific questions, we can go from there.
Okay, so I guess my first question really is going from that early concept pre-seed to the first point where you're doing an ask.
Yeah.
Bootstrapping along that process. What kind of numbers would you typically be looking at for making the decision to go from, okay, this is a great concept, to, okay, this is a viable concept? Monthly revenue?
Yeah.
What are you kind of looking for there?
So are you asking, if you were to bootstrap, what would be the point that would be like attractive to go pursue funding?
Well, I'm under the assumption that at some point a bootstrap company just simply isn't going to, I mean, you're going to reach those plateaus where you can't grow until you have additional revenue to increase profit.
Absolutely.
Or increase production, in my case. At what point, what kind of numbers, percentage wise, or metrics are we looking for making those calls?
Yeah. So and I'll do my best to answer your question specifically to that ask. I'll probably not use percentages. It'll probably be a little bit more about like a personal wealth, sort of just gauging your overall sort of asset distribution. So if I were bootstrapping a startup, right, and I were trying to determine, should I do this? And also, if I should, what's the point where I can't go any further, right? A couple things to keep in mind are, one, financially, do you have the means to safely do it? That's probably consideration number one, right? And on that, the one caveat that I would add is, if you are exceedingly wealthy, right? Maybe you're already a founder, maybe you just come from money, whatever it might be. If you like legitimately could finance your company for say $500, $2 million, you can, but like, the thing that I've seen happen pretty frequently is that, not too frequently, but it's common, you put too much money in, especially people that have just maybe gotten out of a recent exit. They put too much money in, and then they capitalize on terms that are really convenient to them as a founder. And then other investors, when they come in, are not also the founder, right? So they have a little bit more of like a pushback because there was a clear conflict of interest. So if you give yourself really good terms in your bootstrapping by actually documenting around, be careful of that. But otherwise, what I would say is, frankly, if you can, like, here's a good example. I think Slack didn't do a round until an A or a B round. Like, there are big companies that GitHub, sorry, I'm misspeaking. GitHub didn't do any sort of round until they bootstrapped to a basically too early growth stage. So that, that shouldn't be your expectation, but if you can get to a point where you can become cash flow positive, and also still represent aggressive growth from bootstrapping at pre-seed, that's great. I mean, there is a point when you're probably going to be deciding between going the venture route or kind of going maybe a non-conventional funding path, right? But for pre-seed, if you can self-fund your pre-seed, there's no reason not to. Also, well, there's always a reason not to, but if you can, it's worth assessing. But if you're only going to be able to bootstrap it for like 3 months and achieve nothing substantive for bootstrapping it, that might not be worth your time, right? So if you're going to bootstrap, make sure that you know exactly what you're trying to get done via bootstrapping. Like, if you're trying to get good example, right? It's probably really, really wise to bootstrap until you get a proof of concept, right? It's going to be a lot harder to raise money without a proof of concept. So that's probably a really good time to bootstrap. If you can bootstrap your early traction, even better, right? But there's a point when honestly, even as a strong company, if you're really crushing it, people are going to be banging down your door to try to put money into your company, right? Like you will be taking orders. Like healthy companies that are that robust and scaling that well, it sort of flips where VCs now become pretty interested in you as opposed to you becoming interested in them. So it's not that there's really like a specific percentage or a specific quantity where you should flip, but it's one of those things where if you can't bootstrap in a way where you can feasibly accomplish something that will help you either get to cash flow positivity or revenue or whatever your metric is, right? In terms of where you're at, you probably shouldn't do it. If you just can't do it via bootstrapping, you might have to eat the frog, right? And go try to raise and give up some equity. So if you need 200 grand to get off the ground and you don't have that, that's completely okay. Most people don't have 200 grand of disposable income, right? So that's how I would gauge it. I hope that was helpful. I can go into more detail though, if that wasn't clear.
No, that was good. Thank you.
Cool.
Thank you, everybody, for joining us. We'll see you again next week. Same day, same time. And I hope everybody has a good evening. Thank you.
Cool. Thank you, guys.